Welcome back to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really pleased to have with me for the first time Dr. Keith Weiner. He's the CEO and founder of Monetary Metals. Keith is a leading authority in the areas of gold, money, and credit, and has made important contributions to the development of trading techniques founded upon the analysis of bid-ask spreads. He is the founder of Diamondware. It's a software company sold to Nortel in 2008, and he currently serves as president of the Gold Standard Institute USA. Keith earned his PhD from the New Austrian School of Economics. Welcome, Keith, and thank you for joining me today.
Thank you for having me.
It's good to talk to you. I've learned a little bit about you. I visited your website at monetary-metals.com, monetary-metals.com, and ran into Addison Quayle, who works in your shop, and he's the one that's responsible for making me aware of what you're doing. And I just read a very brief bio, but I'm wondering if you could talk a little bit more about your background before you founded Diamondware, and how did you come to discover Austrian economics? Because there aren't too many people out there. It seems as though there's a sort of a statist attempt to keep people ignorant about Austrian economics and keep us all believing in the religion called Keynesianism. But can you give us a little background on your, just a little more background on your past?
I was your classic computer nerd. Who spent all my time hanging out in the computer lab until my parents finally got me a computer, I think freshman year of high school. And I spent every waking moment on it. Went off to university, RPI in upstate New York, majored in computer science, dropped out because I got bored and I wanted to build a software company, which I did from 1994 to 2008. Sold that to Nortel. To make a long story short, the acquisition occurred at the absolute most incredible time you can imagine. It was August 19th, 2008.
Ooh.
So I looked it up. We were the last acquisition Nortel ever did. I knew at least two other companies that were in the process of being acquired that never got their deals closed. Of course, within the next 3 months is when the majority of the market collapse happened.
Sure.
And it was that market collapse that made me start to study markets first and then economics to figure out what the heck was going on. Because nothing that I saw on TV, nothing that I read made any sense. Everybody seemed to start in the middle and sort of meander around in circles with nobody really trying to get to the root of the problem until I came across the writings of this Professor Antal Fekete, retired Hungarian-born professor of mathematics in the Canadian university system, but really a autodidact and passionate about monetary economics.
Yes, I know him, actually. I know him, and I haven't spoken to him in a number of years, but I probably knew him maybe before you did, actually. I'm remembering him, and yeah, he's someone I should get on the show again sometime, no doubt about it. He was on my radio show many years ago. But go ahead, I'm sorry.
So, I started to study under him without any particular intentions, just because I was fascinated by it, and because I had done well in my sale of my company to Nortel, and I wanted to figure out how to protect myself. The deeper I got into it, the deeper I realized just how serious the monetary problem is. And then two things clicked for me. One is I'm not an academic. I consider myself to be an entrepreneur. And as I started to think about what's my next venture going to be, I said, I want my venture to be something that has to do with a solution. If it was a normal world, it would be another software company. I had built a great team over many years. They followed me to hell and back. They were ready to jump from Nortel went bankrupt, and then everything got acquired by Avaya. I had access to capital. I had great advisors. I would have done another software company. But I said, there's a problem. There's a cancer in the world, and I want to try to do something about that cancer if I can. And so I want my next venture to be in the gold space, and so thus Monetary Metals was born.
Yeah, and actually, before we go any further, I want to tell our listeners that on your website you gave a lecture at the Harvard Club that I think is very well worth people going to your website to watch. It's the title of your talk was cancer and the solution, or what was it? I'm forgetting exactly what the title
the
of the
dollar
talk
cancer, the dollar cancer, and the gold cure.
It's excellent. I started watching it. I watched about 3/4 of it, and I ran out of time earlier today. But I want to finish watching it, and I think you diagnose the problem very, very well, understanding the pathology of Keynesian economics, and you're providing a solution. So for people to try to protect themselves, and what you're trying to do is share what you've learned, your insights, and your efforts to protect your wealth from the ravages of inflation, a debasement of the currency. And so let's get right into it. Your company, tell us what you're offering people now. You're offering a return on gold. I mean, one of the things that we've always told you don't want to own gold because you can never get any return on it. Never mind the fact, of course, that gold retains its purchasing power for centuries, while all the currencies enter the dustbin of history eventually. But let's get right into it. Tell our listeners what your company is providing for them. People that own gold can invest their gold in short-term loans, relatively short-term loans, I believe. But just get into it. Tell us about your product.
You know, I was going to say, I call that the Warren Buffett argument, that he says, if you're observing Earth from Mars, how did we pay all these guys to dig the gold out of the ground, and then we pay more guys to dig another hole and put it back in the ground and stand around guarding it. Gold has no utility and no yield. And, of course, the gold bugs hate him for it because he's so disingenuous to imply that the dollar is superior, which it isn't. But he's right about one thing, which it didn't have yield. And so it's not a productive asset. And so our vision, it's important to talk about why we're doing this. And that is, I came to the conclusion through my economics work before founding the company that interest in gold, particularly interest is a regulator of flow. That you always have people that are taking gold out of circulation to hoard it and save it. And there needs to be a countervailing force to pull it back into circulation. Counterforce interest. If the interest rate is zero, nobody will part with their gold. It will, even if you had a working gold standard, all the gold would slowly be picked out of circulation, and the thing would seize up. And so, from where we are today, if you want to get to a gold standard, it's not a matter of price. It's not a matter of the gold price, going to $2,000 or $5,000 or $50,000, whatever number you could name. It won't circulate. It can't circulate. Because people don't want to part with their gold. That if gold went to $50,000, that would just be confirmation that you had done the right thing, and the dollar was that much more collapsed than just today. But if you offer interest on it, then that changes the equation. And so I think, to me, the root of all of Keynesianism is the perverse incentives.
Yes.
And so he quotes Lenin in, I believe it's Consequences of the Peace. He quotes Lenin, and most gold bugs are familiar with the first part of the quote, where he says, there's no surer way to overthrow the capitalist order than by debauching the money. Quite a lengthy quote, but the end of it is not as well circulated as it would be. The end of the quote, he says, by engaging all the hidden forces of economics in favor of destruction, not 1 in a million can diagnose what's happening. And I think about that a lot, and then I think, okay, well, hidden forces of economics, today we would use the word incentives. So they've set up a lot of perverse incentives. That's why the system operates and why the dollar still continues to have strength, by the way. And, I thought, okay, well, what if you could offer a new incentive? What if you could make it profitable to move to the gold standard? And so that's the why of what monetary metals, behind what we're doing, is trying to find a way to move to the gold standard. And the way, the incentive that people respond to is if you make it profitable. So we can say to an investor, hey, look, we'll pay you interest on your gold. I'll get to how we do that in a moment. And we don't have to necessarily, have any discussion about the Fed and QE and printing to infinity and all the paper currencies, after a 40 or 50 year lifespan, turn to dust. You can have that conversation, but we're not obliged to, because selling the idea of getting paid interest on something that's currently a dry asset you don't have to sell it very hard. You just say we're paying interest, and then the conversations, and it's a pretty simple thing. And of course, that's how everything in the advanced economy works. If you want to travel from New York to LA, you don't really want to have a conversation about the engineering of a jet engine. You just want to know there's an airline that will get you there, and how much time does it take, and when to take off, and how much you're going to charge me. And so that's what monetary metals is about.
Okay, so let's find out the fundamental, how it works. How, as an investor, how much gold do I need to own before I can invest with you, and what can I expect to? How much can I expect to make? What kind of yield can I get on it? What's the duration? Fill in some of the practical aspects of how my listeners and myself, if I'm interested, can get involved in your program.
Size is 10 ounces of gold. And I name it in those terms. A lot of people say, well, how many dollars is that? I say, well, it's, $13,000. We like to think in terms of gold. And part of what we're doing is a paradigm shift to start thinking in terms of how many ounces rather than how many dollars are those ounces worth. So the minimum count size is 10 ounces. And then the way it works is we bring lease deals. It's not actually lending. I'll get to the distinction in a moment. There's a lot of awareness of gold leasing by what the bullion banks are doing, and that's not what we're doing at all. But I'll get to that in a moment. So we bring lease deals to our account holders, where we say, here's the company, and here's what they're doing, and here's what they need the gold for, and here's how much gold they need, and all those details. And then each investor can decide how many ounces they want to put into that deal, and at what minimum interest rate they would demand in order to go in. And so part of our innovation is to create a market in this, and be very, very conscious of what Hayek called the fatal conceit. Keith, you studied gold in the 19th century, gold banking, and you know what the interest rates were. What do you think the interest rate should be? And I just want to say, well, look, let me defer to the market.
Yes.
Enough people with enough liquidity decide what it should be. Right. And then there's some more validity to that. So the distinction we're making is that this is leasing, like leasing any tangible property. If you have an old iPhone and maybe your kid's friend is like, hey, I could use an iPhone, and you're like, all right, I'll let you have it for $10 a month. It's still your phone. He owes it back to you at the end. And then he's paying. With gold, there's really no difference, except obviously, number one, gold is far more precious than an old iPhone. And number two, gold can't really be broken or damaged or, squashed and dropped on the floor. Even if it is, it's still gold. The virtue of the lease is that the investor in a very strong position, you retain title to the gold. So there's no sale of gold. So if you bought your gold at $200, you're not being taxed on the gain as if you sold it at today's price at $12.90. And perhaps even more importantly than that, you're not a lender, and the company who's using the gold is not a borrower. The gold does not become their asset. It does not go on their balance sheet. And if they declare bankruptcy, the gold is not lost, and become an asset to be liquidated for the benefit of all the creditors in aggregate. It's just simply leased property. It's like leasing a car in that sense. Let's say you lease a car from Chevy, and then you declare bankruptcy. Well, Chevy just repossesses the car. The creditors can fight over whatever assets you may have, if any, but the car isn't available to satisfy the creditors.
All right, Keith, we've only got about 3 minutes left, 2.5 minutes or so. What sort of yield can people expect, and what is the duration of these leases that they make through your firm?
Typically 1 year maturity, we were seeing interest rates in the 3 to 3.75% range, 3 to 3.75. we recently added, and we announced a couple of weeks ago, insurance from a major global, London-based global insurance carrier, which we can talk about who that is offline, but not but in an open forum. Mm-hmm. And the investors have responded to that with lower rates. And so we feel it's really a win-win. It's good for the lessees who are getting a lower rate. It's good for the investors because it takes out most of the remaining risk. So the insurance even covers, what if the lessee pulls the gold or embezzles it and then flies to a non-extradition country? It even covers that kind of fraud and embezzlement type stuff. Mm-hmm. And so most recent deal, and we have on our website, there's a little widget you can see the recent deals. Most recent deal was 2.5%.
2.5%
that is gold on gold.
Yeah. Okay. And what was the lessee paying?
We charge a spread of 2%, so the lessee is paying 4.5%.
Okay, and that's what another question. The answer to a question is, you obviously have to make money to stay in business, so that's that spread between your clients that own the gold through your firm and the lessee. Okay, and are these just with 1 minute, maybe 30 seconds left? Your borrowers, are they? I mean, one is a jewelry company, I believe, or a company that's involved in jewelry. The other one does something different.
The other company I think you're referring to is Valorum. They manufacture a little gold currency unit. It's roughly the size of a dollar bill, but it's clear plastic with a very thin foil of gold in between, 1/10 of 1 gram. And so that's something that's designed that could actually circulate. The other objection to gold is you can't buy groceries with it.
Yeah.
Well, 1/10 of 1 gram is about $4 or $5 of gold.
Yes,
you can actually buy milk and bread and eggs and cheese with it.
Keith, we're going to have to leave it go at that. We're out of time. So much more to talk to you about. We'll want to do it again sometime in the near future. Thank you so much for being with us today. It's monetary-metals.com, monetary-metals.com.